Hey guys, welcome back to the Genesis Blog podcast. Today is number 7 of our protocol analysis series, where we analyze different protocols with a investment template we had created. Today's protocol in question is Nexus Mutual, which is uh, kind of an insurance platform, but not really. But Sid Shah is going to lead us today and explain it to us. So, without any further ado, take it away, Sid.
Yes, thanks, Yash. Yeah, so Nexus Mutual essentially you can think of it as a decentralized insurance protocol. And like before we dive into what exactly Nexus Mutual is and how it works, I'll just rattle off some of the important facts. So, firstly, is based on the Ethereum blockchain. It's raised $3 million of funding from the likes of Blockchain Capital, Semantic Ventures, Collider Ventures, 1KX, One Confirmation. And it actually covers a significant number of protocols in terms of providing insurance for products across those protocols. There were at the last count that I did a couple of days ago, about 122 products that have been covered across protocols for a variety of different types of covers that they've got, right? So the first thing to understand about Nexus Mutual is that it is set up as a mutual. So it's set up as a company limited by guarantee in the UK, and it operates under a discretionary mutual structure. So the members of the mutual have a legal right to proportional ownership of the mutual, and they're responsible for providing a guarantee. So the guarantee is just a nominal figure. It's about like £1 per member. So if the mutual ever runs out of money, each member is only liable for a further pound. So it's not much, right? Um, so essentially, a mutual is not really a provider of insurance, but it's a legal structure which enables members to trade with each other under one legal entity. So it doesn't need to conform with all the legal and regulatory requirements that the entire insurance industry needs to comply with, right? And just that it's also got the benefits that its products are not subject to insurance premium tax, and any surplus or distributions aren't taxed in the hands of members. And the mutual just pays tax on whatever trades are done outside of the mutual. So essentially you can think of it as being set up as a to enable a decentralized alternative to insurance. And the mutual operates as a kind of risk sharing pool. So that everyone in the mutual can purchase and be covered by the products offered by the mutual, right? And it's fully owned by the members. And it's in the traditional manner, like we've grown used to. These the way these protocols work. It's got a bunch of token incentive based mechanisms to incentivize and participate in risk assessment, claims assessment, and overall governance of Nexus Mutual, right? So there are a few key components of Nexus Mutual that are important to understand. Firstly, right, like I just want to talk about the trends, essentially why there has been a need for such a mutual to emerge. So firstly, there's the blockchain and crypto angle, which is that obviously we're in a very nascent industry, and a lot of products and projects are very new. The code, the protocol itself, it's not really battle tested. And there are people, and again, there's not like a regulatory or legal wrapper that allows that allows people who participate in crypto to be covered by let's say like in the US you have FDIC insurance or something like that, right? So there's nothing like that for crypto projects, and there's therefore inherently a need for insurance to be provided for these products, right? So there is a demand that from users of protocols and smart contracts, etc., to actually purchase cover, and there's essentially therefore a demand to pay premiums to any sort of protocol, any sort of entity that is willing to offer insurance products. And another one would be just, problems with the current insurance industry. So as we've seen, as a common theme across a lot of the protocols that we've covered and a lot of protocols that we've seen elsewhere, there are inherent issues with the way that the industries that they're in currently work and operate. Right. So today, for example, insurers decide how customer money is handled, including how it's invested, which risk still back, when it gets paid out to shareholders. So it's a bit of a black box, and people who pay premiums and purchase cover don't really get to decide on any of that. Right. So interests aren't really aligned, because the thing is that there's unlimited upside for the insurance company to be able to manage the money because they reap the profits of doing so. But the customers suffer when if the insurance company goes bust. And I mean, we saw that, right? We saw that during the 2008 financial crisis when Aon, I think it's Aon that went bust. Or like, well, not
I
really
think it
went
was
bust.
AIG, right?
Sorry, it was AIG. So it was AIG
Yeah.
that
Both
that
United sponsors, but yeah, AIG
yeah.
went bust, which is why Aon became a sponsor.
Yeah, exactly. Sorry, AIG became bust, exactly. So yeah, another point is that it's difficult for customers to also understand how safe particular insurers are, right? Like, I mean, if I gave you an option between five insurers, would you have any idea of telling me which one is the more safe insurer? I mean, I kind of doubt it, because people just take the deals that they're offered, right? So there's no real way for anyone to judge how safe a particular insurer is without delving incredibly deep into how they work. And today also, 35% of insurance premiums are lost due to frictional costs in the system. So only 65% of premiums are returned to customers via claims. So the traditional inefficiencies of the current system, that have that have just replicated themselves in the insurance industry as well. Right. So there's not there's obviously a bunch of problems and a large market for someone like Nexus Mutual to address. Right. So now, just to get on to how Nexus Mutual actually works. So there are a few.
Before
Sorry,
that,
go on. Yeah, before
sorry,
that, go on.
just
Sorry.
I wanted to just like clarify certain things. So, I
Yeah,
mean, to understand anything, I like to break it down to like as basic a level as possible. So, the
yeah,
way insurance works is that everyone knows that the chances of something like a car crash or your house getting destroyed is very low. It's a tail risk, but they
yeah,
would still want to insure against it, and everyone would want to insure against it. But the chance of it happening to everyone is very less and only happens to a few people. So, all
yeah,
insurance is a bunch of people pooling in money and a few people get paid out of it because the thing they're insuring against happens to happen to them. So
yeah,
the way it traditionally worked is that lots of people give money to an insurance company, and the insurance company has to pay back a few people. And while they are in custody of the money, they have to basically reinvest it to ensure that they get a high enough return as an insurance company and remain profitable.
yeah,
There is an inherent you know difference in incentives for users and the insurance company. The insurance company is incentivized by profit maximization, while the user wants the highest claim possible, right? And
yeah,
then, like any traditional Web2 company, there has been a increase in efficiency due to changes in tech. So like in fintech, even though the traditional banking system was there, fintech companies came and built on top of it to make it more efficient, but underlying the system was flawed, which is now insurance aggregators like Policy Bazaar are coming in and doing the same thing, where they are building a good digital platform to people for people to come on, but it's still based on a legacy system of insurance, which is why Web3 insurance is like a complete change in that whole dynamic, the same way DeFi was.
yeah, exactly. So that's a really good overview of how insurance works today, and like what again the issues with insurance are in the current system, right? And I think that to a certain extent, Nexus Mutual replicates how the process of insurance works today as well, but it does it in a more decentralized manner. It gives opportunities to a bunch of more people and entities to actually assess the risk of to actually assess the risk of a protocol or a product or something like that. And it also allows a lot of people to assess claims that for example, if I've insured something and that event has occurred, then I'm going to make a claim to the insurance company. And a lot of and a more decentralized set of claims assessors is possible with something like Nexus Mutual than it is with a traditional insurance company. So yeah, just how Nexus Mutual actually works. So as you might have guessed, right, there are two or three key components to how an insurer actually works. So in this case, Nexus Mutual has got two main components, I would say, and a bunch of other obviously like really important components as well. But the two main ones, in my opinion, are the claims assessment and the risk assessment, right? So the risk assessment, firstly, is for example, if a new protocol wants to list on Nexus Mutual, uh, risk assessors need to stake NXM, which is the native token of Nexus Mutual, to open up cover availability and bring down the cost of cover. So, for example, if a product wants to be listed, then risk assessors will need to stake NXM against that product to signal that people actually want that product to be covered by Nexus Mutual, right? And we'll get into like what the uses of NXM are later on when we talk about the tokenomics and that aspect. So for example, risk assessors, they stake NXM against protocols, custodians, and cover products that they believe have bug-free code. So if a risk assessor has high confidence in a project and they believe that it's safe and trustworthy, then they stake NXM against that project. So for example, if there's a high premium, so the amount that you have to pay every so the amount that you have to pay every month uh, for the cost of insurance, it if it's much higher than than you would expect, it's because of two main reasons. So either the project's not safe or trustworthy, or the demand for cover on this protocol is too low, right? So enough people don't actually want to provide, no one's using this, so like the demand for the cover for this project is not enough, so people are just unstaking their NXM, and therefore there's a high premium, right? Because you need to justify you need to essentially like grow the pot of money that you can potentially pay out your the people who are insured with, right? So NXM can be unstaked at any time. So there's a 30-day withdrawal period. And actually, if a claim is accepted and a payout occurs, risk assessors staked against the protocol of the custodian, they'll have their staked NXM burnt on a proportional basis to facilitate the payout. So what this actually means is that risk assessors are incentivized to correctly judge the risk of of the project or custodian or whatever that they are providing cover for. And if there is a claim made against that project and they've said, oh, this project is safe, you can the premium's going to be X amount. And if there's a claim made against that project and that claim is successful, the NXM that they've staked is burnt and is used to pay out a proportion of the claim, right? So so NXM, they want to create as much cover as possible with the staked NXM. So they want to essentially have as capital efficient a model as possible, right? So funds are held in the capital pool, and we get into the capital pool in a little bit. But funds are held in the capital pool with NXM that represents the membership, and NXM acts as the capital to back the cover. So risk assessors therefore can stake against protocols, custodians, and cover products with a certain amount of leverage, right? Um, so the mutual, it places capacity limits on the amount of cover that's available on specific risks. And because you don't want to be too exposed to one specific kind of risk. So for example, there are specific risk limits and there's a global capacity limit. So the specific risk limit is based on the amount that is staked to a particular risk, and a global capacity limit is based on the overall capital resources of the mutual. So the lower of these two limits applies, right? And yeah, so the capacity on any particular risk is limited by the amount of staking on that risk. So again, like if there's no staking, the mutual does not offer any cover, right? So yeah, like in a nutshell, this is what the risk assessment angle of Nexus Mutual looks like. Right. So and just to boil that down and summarize it, risk assessors need to stake NXM against protocols or projects to be able to provide cover for that protocol or project. The amount of capacity, so the amount of cover that Nexus Mutual can provide in aggregate. So let's say that they can provide 100 ETH worth of cover is dependent upon the amount of NXM that is staked to that particular project. And if there's a claim made on that project, then the NXM is slashed or and burned. The staked NXM is slashed and burned to be able to provide a payout to the person who's making a claim. Right? Does that make sense to you guys?
Yeah.
So I have a few questions. Okay, so let's say I want cover on like Uniswap, for example. Okay, I want cover against smart contract risk on Uniswap. So as a risk assessor, I will, if I think that Uniswap is, it's a good protocol, there's not going to be any bugs, etc. I can stake Maker towards
Not
the
Maker.
Uniswap. Sorry, I can stake
No,
no,
NXM
sorry, stake NXM to the Uniswap pool
product
on the
or
Nexus,
pool.
on the
Yeah.
Uniswap product pool, whatever, on the Nexus protocol. Then basically, if there is a bug on the Uniswap protocol and the person who wanted a claim on it is coming for their claim, then Nexus is burnt, and the user who wants cover will be paid back in Uni tokens or in Nexus tokens, or how does it work?
I think that they would be paid back in, whatever token that I guess like it would be usually ETH. So
Oh,
they would
okay.
probably pay them back in ETH. They would burn the NXM in order to essentially yeah, they would burn the NXM in order to to pay for that ETH, right? So
So Nexus has a
like
treasury. Is that where the money is
yeah,
coming from?
Nexus does have it does have a treasury. So like for example, right, the Nexus Mutual token, like it's not it can, so we'll get onto the redemption aspect of it later on, but yeah, Nexus, there is a treasury of ETH that NXM can be redeemed for. It's not really like an empty token that just exists, like it needs to be redeemable for a liquid token, because NXM actually can't be bought on the open market.
Okay.
It's yeah, so it is redeemable for ETH.
Okay, so if I am a risk assessor, to get the NXM, I first have to deposit in the treasury.
you
ETH.
you have to you have to buy membership
Okay,
to the mutual, right?
correct.
Like you have to buy a certain level of membership to the mutual, and to be able to get NXM. Yeah, like for example, like you just get you can purchase NXM to buy. You need to buy NXM to buy cover, essentially. So you buy membership to the mutual, you buy NXM, and then you get you essentially
You can stake your NXM then to
you can
whichever
stake your
pool you want
NXM.
to.
You can
Yeah.
stake your NXM as a risk assessor. You can, like in order to, for example, purchase cover, NXM is burned or used to purchase that cover. So you buy NXM and you burn that and you go like, okay, I'm gonna buy cover for this protocol.
That's kind of brilliant in a way, right? Because you're putting buying
Yeah.
pressure and you're also burning it if they don't correctly assess the risk.
I mean,
So
yeah,
in a
exactly.
way,
And
long
yeah.
term, the best risk assessors would remain on the platform, right, and make it more and more efficient.
Yeah, and the thing is that with the NXM token itself, like I mean, I think it's a great idea because it's not actually tradable on the open market, to like a certain extent, and we can get into that later as well. But it's a very useful thing that it's not tradable on the open market, because it should be a closed loop system in which like the members and like the users of the protocol are the ones who benefit from it the most, right? And it's essentially shielding the protocol from a lot of unnecessary speculative activity, which it does not need. So the token price here is actually it's a controlled token price that can be shifted up and down depending on market conditions. But let's get into that later.
Okay. Okay,
Okay,
I have
so
another question.
just one more thing on this before we move on to the other question. So the the whether the source of the cover, right, is essentially aggregate amount of um the risk assessor's buy-ins plus the premium that the person who wants the insurance is paying. Is that correct?
I mean, yeah, like you can look at it that way.
No,
Right?
wouldn't the risk assessor, I don't think it would work that way, right? The risk assessors, whatever his stake is going to get burnt if they come to claim
Yeah,
their
but
cover,
then,
right?
but like that
Yeah.
stake gets burnt, but then that's redeemed for ether or
E-
whatever, right? Like
No, so
it's
my question is, where is that ETH coming from?
from the it's coming from premiums, but also I need to I think I need to like check this about the
I don't
payout.
think they burn and then buy ETH. That would make no sense. If it's
So it
burnt, it's
might be
burnt, right?
redeemable.
So
And
It-
they've also got like a treasury in which they've got a treasury that they invest, right? Because they do the asset investment aspect of this as well. Like for example, they hold all funds on chain, right?
Correct.
And they do like buy and hold, they do buy and hold strategies, for example. So they lock up ETH, they invest in financial instruments based on collateralized lending. So they have those funds that they invest in order to in order to fund like the payouts, and also like
Correct.
the NXM that is staked, like you're purchasing it for some sort of other token, right? Like if you're buying NXM, you're buying that NXM in
no,
ETH.
I mean, I think because there's a risk of it getting burnt, they're taking a risk. And when you take a risk, you should be rewarded. And I'm guessing they would be rewarded with a part of the
They
fee
get more
if there's
they
no
get more
claim.
NXM.
No, whatever the person who wants coverage is paying, and if there's no breach or whatever, there's no bug, and they don't need the insurance back, wouldn't a part of that fee go to the NXM staker?
Yeah, no, but like it goes to the treasury as well, right? Like okay, so
Yeah, yeah. So
NXM
part would go to the
stakers.
treasury and part
Yeah,
would go to the staker in that particular pool.
so risk assessors earn proportional rewards in NXM equivalent to 50% of the cover premium.
Okay, so
So
Okay, and
50%.
then the rest would go to the treasury, I'd
yeah,
assume.
But the initial
yeah.
Okay.
treasury was funded by like
But
external
obviously, right, like, okay,
financiers.
so think about it, right? Like if you're buying membership rights to the mutual, you're paying in ETH or in like whatever token you want to. So that money goes into the treasury. Yeah,
Correct.
Yeah.
you're buying NXM tokens in the first place to be able to stake it and earn more NXM tokens and like risk assess and claims assess and all of those things, right? So that you're buying those NXM tokens with some sort of cash, like with some, not cash, but like with some currency, with some asset. You're buying it with ETH. So that ETH goes to the treasury as well,
Okay.
right? So
Okay.
when that NXM that is staked against a particular product is burnt, that means that the ETH is redeemed and like paid out to the or DAI or whatever, right? Like ETH or DAI or USDC or whatever. I think it's
Mhm.
ETH and DAI only.
Okay, got it. So the
Yeah, it
sources
is.
of
It
the
is.
treasury is threefold: the membership payments, the NXM payments, and the premium paid by the
Yeah,
retail whatever who won the insurance.
yeah.
Got it.
What do you mean by NXM payments?
Like
Like NXM like rewards,
once you
right?
Like
buy NXM,
inflation?
you have to buy NXM, right?
Yeah,
Yeah,
but
so
then that's, I mean, how are you paying for anything with NXM?
No, no, no. Wait, if I'm understanding correctly, you first buy membership to the mutual. That's one
yes.
source of income for the treasury. Once you buy
Yeah.
membership, you earn the right to buy NXM, which you can use to
Yeah.
stake on various.
Yeah.
So that purchase of NXM, does that also go to the treasury?
Yeah. I mean,
Okay,
like in the
yeah.
Yeah,
sense that
that's what
like
I mean.
the money
Wouldn't it
from
just be if you buy NXM, you get the membership, like you're buying
no, but you can't
into the
buy
protocol?
NXM. You can't buy NXM on the open market. So how can you?
No, like you go on the platform and you exchange NXM
Yeah,
for
but there's
ETH for
also like a
NXM.
membership fee. There's also a membership fee,
Okay,
like
okay,
a
cool.
minimal membership fee, but there is a membership fee.
Okay.
Oh, okay. So yeah, you pay. I just found it. So you pay an ETH or DAI to
Yeah.
basically you pay a small membership fee, which is like 0.002 ETH, and you undergo KYC process,
Yeah.
and then you become a member, and then you pay an ETH or DAI for NXM tokens,
Yeah.
and then you can use those NXM tokens to stake. If you stake correctly, you get a fee from the people who bought cover. If you stake wrongly, your stake gets burnt, and the people who paid for cover get their money back. through
in ETH or DAI
whatever. That's
or
the
whatever.
yeah.
Got it.
Exactly. Cool.
Cool.
Okay, so next, just to touch upon claims assessment. So claims assessment can be done in two ways, right? So so essentially, you can first either use an oracle, which is a trusted off-chain information provider, or you crowdsource information and assess claims using like voting mechanics, like a prediction market. So the claims assessment is done by understanding whether that bug was actually there, whether the person, you just understand whether that person's claim is legitimate. And it's obviously a lot easier to do on the blockchain because all of the data is transparent, right? And available, well, most of it at least. So the way that the claims assessment works is that voting with a consensus outcome, it entitles claims assessors to a share of the fee pool. So fees are paid as additional NXM tokens, and they're valued at a fixed percentage of the cost of cover. Voting against the consensus outcome, it results in locking of the stake or the bond for a longer period. So they don't really want to burn these tokens, but they just want to lock it for longer, so that, like, exit liquidity is lower, right? So so obviously, and they don't want to burn it, because if there are genuine differences of opinion, then you don't want to just burn the members' tokens and say, oh, you're a bad claims assessor. That just disincentivizes people from voting, right? Or like assessing claims. So the voting power must add up to greater than 5x the cover amount. And the voting power is determined by the number of stake member tokens used to vote. So obviously, like, you've gleaned that, you need to have you need to be able to stake the NXM tokens in order to be a claims assessor as well. So no consensus results in a reduced fee pool for all assessors, and the claim is then escalated to all Nexus Mutual members for a vote. And the important thing here is to understand that Nexus Mutual has actually tried to put in a process in place to make sure that claims assessors don't deny legitimate claims, because obviously if you deny legitimate claims, then no new users would come to the platform, and there would be no one who would actually be using Nexus Mutual, right? So what Nexus has said is that they've tested the design with their partners, Incentive AI, and Incentive AI uses machine learning algorithms and I'm quoting, model the behavior of economically incentivized AI agents. I don't really know what that means, but they said that they've identified a combination of parameters which give confidence that close to 100% of genuine claims will be paid, and close to 0% of non-genuine claims will be paid. Now, I have no idea about how this actually works. But I guess it is encouraging that they've at least, pointed out very clearly that this is something that is a legitimate threat to the stability and success of the protocol, and they've taken a step to, to address it. So that's essentially how the claims assessment process works. Now the capital model, right?
One sec. Before we go to that, so what exactly does this AI machine learning thing do? Like, why is it used?
So that,
not like how does it work? Like, why is it used?
Because they want to essentially make sure that someone who's a claims assessor is not someone who's a claims assessor is not denying a legitimate claim, right? Because think about it, right? Like, if you keep on denying a claim, and if you keep on denying, like if you just keep on say, people just will never get paid out.
Right.
Okay, cool. So the next thing is the capital model. So the capital model is, it's essentially the pool of capital that they need to have in order to be able to pay cover out. So they have so it uses an insurance industry standard. So it's called EIOPA's Solvency II methodology. So what they want, what this methodology is constructed to avoid, is so it's calibrated to withstand events in a year with 99.5% probability, or essentially a 1 in 200 year event, right? So another method would be to 100% collateralize the insurance contract. So you hold the full sum assured value at all times. But this obviously would be a severely reduced capital efficiency, and they won't be able to raise funds appropriately, right? So they set a minimum capital ratio value when the pool launched, and it can't ever drop below this. So I think it's about like 162,000 ETH at this point. And the total the minimum capital ratio will need to be calculated regularly. So they want to calculate it at least once per day, and they're going to do the calculation off chain. So yeah, the way that the capital pool is funded by members pay, as we discussed, members pay a nominal fee for membership, and they contribute into the capital pool by either contributing funds directly, but also by purchasing cover products. Right. So the minimum capital ratio calculation is made up of two components. So they've got this thing called a best estimate liability, which represents the expected loss on each individual cover, and a buffer, which represents the funds the pool needs to have in order to survive a black swan event, right? So I'm not going to go too deeply into the way that these calculations are done, but the best estimate liability is initially equal to the total risk cost across all the active covers on the mutual's books. And yeah, like and they've got another module in this, and they've got two different modules in the buffer. So the buffer's got a smart contract cover module, so it's based on the exposures that Nexus Mutual has to the covers that it's written. And there's a currency module as well, which allows for fluctuation in the value of other currencies like ETH and like DAI relative to the base currency, which is ETH. So the scenario with the lowest resulting MCR percentage coverage across both the best estimate liability and the buffers picked out. So yeah, essentially the capital model, and we'll get into, when we're talking again about like the redemptions and the tokenomics aspect of this, we'll get a little more in detail about how the capital model actually works, and like how redemptions are allowed for Nexus Mutual members and stakers and all of the and all of that. The capital model. Now, just want to touch upon. Sorry, go on. You want to ask a question?
No, no,
No,
no.
all good, cool. So yeah, just want to touch upon like two or three key aspects now that are left in terms of like how Nexus actually works and the functions that it runs. So the first is asset investment. So as Yash mentioned earlier when he was explaining how the insurance industry works, an insurer or like a mutual in this case needs to invest the funds that it has to be able to earn a good return, and also to be able to make sure that its assets and liabilities are balanced. So Nexus Mutual, it restricts itself to assets of ETH and ERC20 tokens only. The investment process is automated using Uniswap, and it tries to do only a buy and hold investment strategy. So trades will rebalance the pool as needed. Um, and yeah, so there are trading triggers to deal with liquidity needs that arise from claim payments. And so the way that they want to generate a return the ETH that they hold in the treasury is through so they want to in proof of stake invest in financial instruments based on collateral. Okay, so any changes to the so each asset held by the mutual apart from ETH has a minimum threshold and a maximum threshold. So they've got like a range in the number of units of that asset that they can hold to reduce concentration exposure, and like to increase and to increase diversification. Um, and any changes to the asset list and thresholds need to be approved by the members through the governance module. So they've the investments that they've currently got are only two main ones, which is staked ETH with Lido, and a Maple Finance deposit that's tracked via the Nexus Mutual Enzyme Vault. So the initially the the asset liability management or the asset investment considerations weren't really important, because the duration of the cover was low, and the initial currency assets, which were ETH and DAI, were they were in the same denomination as the currencies that the cover was written in. So the amount that people would be paid out would be ETH and DAI, and they would be holding ETH and DAI anyway. So there wasn't like too much of a mismatch between those. So therefore, the asset liability management wasn't as important initially, right? Um, so that's the asset investment angle of how Nexus works. The target audience now the target audience for the cover is four kinds of is four kinds of entities. It's projects that want to deploy code, so because they want to purchase cover in case anything goes wrong. Individuals that are looking to interact with smart contracts, so people like me and you. Projects that are launching an ICO, who want to essentially give confidence to people participating in that ICO, or like in the token launch or anything like that, to give them confidence that that the code is that the code is covered, and people can purchase cover for that code. And multi-sig wallet contracts, so just so that the funds themselves are in place and they don't just disappear, someone just doesn't withdraw them, right? So those are the four key entities that Nexus Mutual wants to target. But obviously, in the future, if they start adding products that are not only crypto native, so like there are not only smart contract cover, protocol cover, and they're like they delve more deeply into the broader world of insurance, their number of entities and the types of the type of the target audience, the makeup of the target audience will obviously change. Now, the last component is just the KYC angle. And just to briefly touch upon this, but it's obviously important for Nexus to identify every member of the mutual. So there is a KYC process involved, and this has proven to be a little bit of a barrier, because obviously in crypto, no one really likes to do KYC. And so this might limit uptake of Nexus going forward, but it is an important consideration that needs to be there. Cool. I'll just stop here for a second if there are any questions. Otherwise, can continue on to the cover products that they offer and the team.
Yeah, we can
No, nothing from me.
Cool. Perfect. So the main cover products offered by Nexus are of four types. So they've got a yield token cover, which provides cover against yield bearing token depegging. So the depegging risk is covered, and with the value of the token, which is the value right before the hack occurred. Then there's protocol cover, so it protects against a hack on a specific protocol. So things like code being used in an unintended way, economic design failure, oracle failure, governance attacks, protection for assets on layer 2 solutions, non Ethereum smart contracts, and protection for protocol across multiple chains. So I guess bridge hacks, right? Then they've got custody cover, so it protects against halted withdrawals and haircuts on funds stored on centralized exchanges. So for example, if a custodian gets hacked, where the user loses more than 10% of their funds, or if there are any withdrawals from the custodian that are halted for more than 90 days. So those are that's the type of custody cover. And the last one is cover for proof of stake ETH. So ETH, and they've called it ETH2 staking cover. So it's protection against any missed rewards and penalties that are incurred by validators. So any missed consensus rewards as a result of being offline, all deductions made from the covered validators on the ETH2 beacon chain. So this is obviously before the merge last week. So, and for periods post the merge, any transaction rewards missed as a result of being offline. So it does cover the possibilities that have emanated after the merge. So essentially, validators are offline. It covers those rewards, which is actually a pretty interesting thing to consider, because if the validators are getting rewards even for being offline, what really is the incentive to validate as much? But anyway, that's kind of a separate point that we don't want to discuss right now. But I guess obviously that they have considered this, right? Like it must be something like you're offline for a short amount of time and not a significant extended period of time. Because the wording that they've put into their protocol cover, and for each and not only protocol cover, sorry, for like each cover product is pretty comprehensive. So yeah, essentially these are the types of cover that they want to protect against right now, right? In the future, in terms of their roadmap, they want to cover things like dependencies or partial claims. They want to do things like real world products. So they've mentioned earthquake cover. They want to they want to do and like in general, it indicates how these types of protocols, it is important for them to begin their life as providing cover for crypto native products, but there is scope for them to expand to provide expand and provide cover for general risks, right? um right, so that's it.
But this
The
speaks to like a wider argument, right? That even DeFi in general, it all needs to link to real world assets.
Yeah,
Otherwise, it's
definitely.
its own siloed ecosystem, and it doesn't. It's just ensuring one thing that's not really connected to anything to the real world anyway, right? It's
Definitely.
just its own thing.
Definitely, yeah. The real world angle of this is really important, and I guess like when you provide cover for real world products, it just unlocks a whole new target addressable market, right? So it's just a whole new avenue of expansion.
Yeah, and also comes with that much regulation
Yeah,
also. So
of course. Yeah,
two-sided coin.
yeah. Cool. Next thing that I want to touch upon is the team. So the team consists of a bunch of insurance experts. It's led by a gentleman known called Hugh Karp. He's an insurance professional and actuary with 15 years of experience in a broad range of insurance and reinsurance roles. So he was CFO of life insurance, UK and Ireland for Munich Re. Then they've got their operations head is Kaylee Petrie. Previous experience with the UK civil service in the NHS. Business development is Ricky Tan, who's an MBA from UC Berkeley, founder of research company Token Data, and experience in institutional finance and early stage startups. And they've got a few folks on the engineering side as well. So they've got 4 folks on the engineering side. So Roxana Danila, who I think leads the engineering team. So she's a product engineer, 5 years of experience leading and building software products at scale. She was backed by Entrepreneur First and was a tech lead at Facebook. And she was co-founder and CEO at and CTO at Nectar. Um, and there are three other folks, software engineers. So Anatol Prisakaru, sorry, that was a little tough. Dragos Horodnik and Dan Octavian. So yeah, people with 5, 7, 10 years of experience. They've Some of them have worked in the blockchain space, some of them have not, but yeah, enough experience in engineering and development. Their advisory board consists of 5 people. One, two, three, four, five. Right. So it's Hugh Karp, who's the founder of Nexus Mutual. It's another insurance expert called Renis Melbardis, who's a UK actuary with experience leading insurance capital transactions and systems development, valuation and regulatory products. And he was a capital solutions actuary at Aon and head of finance projects at Munich Re. They've got a mutual expert as well, Graham Thurgood, who's an insurance professional of 17 years, set up and ran mutuals in the UK, worked for RSA, Allianz, and Aviva. And yeah, lots of like heaps of experience in the insurance space on the advisory board. Roxana Danila, who leads the engineering team. and they've got Nick Munoz McDonald, who's a security expert, and works and is essentially a smart contract security expert. So they've got a pretty experienced and diverse board, I would say, in terms of covering the exact type of topics that Nexus does need to cover. So I think that this team that they've got is very well balanced. Cool. Anything on that?
No, I mean, it just sounded like they got a bunch of different people with expertise in smart contracts and insurance and engineering and put them together to build a decentralized insurance product, right? I mean, they needed all these people and they went and got them. So
Exactly.
great.
So I think it's a great, it's a really good example of what a team for a product like this should be. So before I get into tokenomics, just want to talk a little bit about just a couple of key facts. Um, yeah, like the revenue that actually, like, let's get into the performance later, but just wanted to point out that they've done 3 audits already. April 2019, June 2020, and May 2021. So clearly due an audit this year. And they're part of the ImmuneFi bug bounty program, and they've collaborated with DEDOB, which offers security expertise. So I guess that they've got the security aspect of their smart contracts under control, which is a really good sign as well. So now let's jump into the tokenomics, right? So the NXM token, right? It, as we've spoken about, it represents membership rights in the mutual. So all members own the mutual together in proportion to their individual NXM holdings. And the NXM token runs on a bonding curve. So the bonding curve defines the relationship between price and token supply. Um, Now the token is meant to, it has 2 main uses. It's meant to dynamically react to the prevailing conditions and capitalization levels. And it's meant to reward active members for participating in claims assessment, risk assessment, etc. Right? So as emissions essentially. So the member tokens, so NXM tokens can be burned to purchase cover, and the token value is determined by the continuous token model. And 90% of the tokens used to purchase cover are burned, and the remaining 10% are locked for the cover period plus 35 days as they're required to submit a claim. And only members of the mutual will be able to own tokens, which is really refreshing actually. And tokens can't be transferred to any any Ethereum address that's not been designated as a member, which is an interesting way. It's just an interesting design structure for the NXM token. Now, what the so NXM, right? The way the token price works is through a formula. The so it's I'm just going to briefly say it. It's not really important for us at this point. But essentially, it's A plus MCR divided by C multiplied by MCR percentage raised to the power of 4, and where A and C are constant values that were calibrated at launch. MCR is the value of the minimum capital requirement in ETH that grows as the number of covers grows. And the MCR percentage is the ratio of the capital pool to the minimum capital requirement, right? And another point is that, cover holders can't really transfer, sell their cover policies at this point. They have to hold them through the duration of their cover. Now, the way that the token price is mostly influenced is through the funding level of the mutual, which reflects the immediate financial position of the mutual. It encourages recapitalization when funding levels are low, and in the long term, the required capital to support the covers, the minimum capital requirement will rise to reflect the adoption of the platform, right? And it's calculated, I think, almost daily. Now, the token price, so essentially anyone at any point can purchase tokens via the token price model. So when funding is required, price is lower to encourage funds to be placed, and the token price increases when funds are higher, right? So essentially to encourage people not to buy as much when there's quite a lot of funding already. The price also increases based on the business growth. As we know, funds are allocated as incentive to perform claims and risk assessment. Right. So the initial currencies that Nexus uses are Ether and DAI. Now, an important aspect to get into is actually the redemption and the purchase limits, right? So next NXM can be redeemed for Ether from the mutual, right? But however, there are several restrictions that apply to the redemption and purchase of the NXM tokens. And they want to put these restrictions in place to ensure that the mutual always has sufficient funds to confidently pay members' claims. Now, redemptions are restricted if MCR percentage is lesser than 100%, and purchases are restricted if the MCR percentage is greater than 400%. And redemptions and purchases are limited per transaction to 5% of the minimum capital requirement, right? And the capital pool also needs to have enough liquidity in ETH to execute on the redemption. And to discourage speculation, the redemption price is 2.5% lower than the purchase price derived from the token model. So essentially, what they're trying to do is that they are allowing for redemption, but they're putting a lot of restrictions on it, and this has actually caused a problem because the because essentially the amount of usage on the platform is obviously restricted, and like people are less incentivized to use the platform as much if they can't even redeem the NXM that they hold, right? And the only way to do that today is through wrapped NXM. Now, wrapped NXM is a one-to-one backed token that can only be generated by wrapping genuine NXM. Um, it's fully tradable but can't be used at all within the Nexus Mutual platform. Only members can wrap or unwrap NXM tokens, right? So it's the only way that NXM can be sold on public markets, which makes interacting with the protocol only accessible to crypto natives. This is fine right now since the main products offered are crypto native ones. But if NXM decides to expand to other risks, user flexibility and options are really important, right? And the thing is that the price of wrapped NXM on exchanges is much lower and completely decoupled from the token price of NXM. So, for example, imagine if I've bought NXM at the token price of, let's say, like $20, but the price of wrapped NXM on exchanges for liquidity is only $8. So that just means that I don't have a profitable and capital efficient form of exit liquidity, which means that I don't have as much of an incentive to actually act as a claims or risk assessor because I can't actually cash out my profits today in the most efficient manner. So that kind of places a bit of a barrier to someone who wants to become to someone who actually wants to become a claims or risk assessor or participate in the protocol, and they do need to sort this out, right? So in terms of the redemption, right, like you can clearly see that there's a problem with this wrapped NXM model, right? And the problem has actually increased, and it's been magnified by the fact that um the minimum capital pool level is set at 162,425 ETH, which sets the MCR at 100%. So obviously below this, no redemptions are permitted. But the problem is that even before the previously, when the capital pool level of ETH was much higher, and the amount of ETH in the capital pool was essentially higher than 162,425 ETH. Redemptions were still not allowed at that point in time, which doesn't really make as much sense to me. And it is a bit of an issue that needs to be looked at, because you can't be restricting the redemption of your members from Nexus Mutual if you want to build a sustainable protocol. That just doesn't sit right with me. It doesn't make sense. And so the only way for them to exit is mint the tradable wrap Nexus Mutual tokens, sell it on the open market. And 25.7% of NXM tokens have been wrapped have been wrapped, right? And it trades as a substantial discount to its stated value of the bonding curve, which means that people are just looking for exit liquidity. They just want to get out. And especially in a bear market and a situation like today, people do want to have control over their holdings, and they don't just want to hold it in Nexus, hoping and praying that they'll be able to redeem at some point in the future for the token price. So I think that this is a bit of a barrier that I've noticed for Nexus. So yeah, in general, that's the tokenomics angle that I wanted to go through, and I know that you guys will have questions and comments. So feel free now.
This whole thing, last bit that we just spoke about, it just shouts of centralization risk, because I would expect if they have a minimum capital pool requirement, under which you cannot redeem ETH. I'm assuming that's encoded in a smart contract, to enforce such a thing. And then if it's above that, then the smart contract will allow you to redeem. But if they're still not letting someone redeem their ETH, that, I mean, we haven't gotten a governance, but it just makes look that the whole redemption is gated by a centralized entity. And this is
Yeah.
no different than, something like a BlockFi or a Nexus, like the other Nexus, stopping your redemptions as a retail investor. So, I mean, this is quite quite significant.
Yeah, I think that like initially they didn't allow for it because they kind of wanted to build up the capital pool and like see how and well, not adversely impact the level of funding in the capital pool and just be insured. But yeah, I mean, like if you said that you're going to be allowing for if you said that you're going to be allowing for redemptions, then you should be allowing for redemptions and you should be giving that flexibility to your members.
Yeah, but we don't know if this is encoded or not, right?
Yeah, I'm not sure whether this
Yeah.
level is encoded. The computation for the for the minimum capital ratio happens off chain, which is a centralization risk. So yeah, like I mean, there are certain there are certain trade-offs in terms of centralization and decentralization that they've had to make. I don't think that that's actually like all of the trade-offs that they've made are bad, and we'll get into that in a second when we cover the governance model. Right, but yeah,
Yeah,
anything
centralization is
else?
But
not
this
bad.
particular thing should not be done off chain, right? Because this is a crucial,
Yeah.
it
Yeah,
really affects the token price, right?
they are doing
And
it. Yeah, I
all
get.
anything that affects token price should be on chain, in my opinion.
Yeah, they are doing it off chain to save on gas costs. But yeah, I think that you're right. I mean that they shouldn't do that.
And if it's
They
fully
shouldn't do that.
dependent on a formula, a mathematical formula, then I don't see why it can't be done.
Yeah, like the capital pool size, right? Like for example, in terms of ETH, in
I think it's
let's say
done off
in
chain because each pool will have different risk assessors saying what should be the minimum capital ratio. Because so like it's a DeFi protocol you're trying to capitalize, and there's no correct answer really, right? That everyone will have different assessments, and there kind of needs to be a consensus, and maybe that's not easy to do on chain.
Yeah, and also like I mean, just to like the capital pool ratio has been below the minimum capital requirement since I guess I mean roughly since I mean I would even say Jan 2021 because it was hovering around that limit for a very long time, and it started dropping I guess like at the end of November 2020, start of December 2020, right? So the capital pool, I guess that they just stopped redemptions at that time because it was getting really close to the minimum capital requirement, and it's not really been higher than the minimum capital requirement for a significant period of time. I mean, it's since December 2021, it slipped below like 162,000 ETH to 154,000, and today it's about like 153,000. So I get why they don't allow redemptions right now, and they are covering more than the amount of cover. That capital pool does hold more ETH than the amount of cover that they're exposed to, which is very important from a risk perspective. But I guess that the redemptions aspect, like if they didn't allow redemptions when the capital pool was at 213 200,000 ETH in October 2020, then that's not a good sign.
And just one more question on the wrapped NXM. So I mean, people sell it to get out of the whole ecosystem, which makes sense. But people who buy it on the in the open market, what is beyond speculation? Is there any reason why they make the purchase?
Yeah, I guess that they could. I guess that it's for those people. Buying the membership fee is cheap, right? It's like 0.002 ETH or something. So they can just buy the membership fee with that address first, get that wrapped NXM on that same address, get it for a lower price in the NXM token price, and then go onto the NXM platform, unwrap it, and then get like a discount.
But then you're risking the centralization thing what you mentioned earlier, that they won't be able to redeem.
Yeah, they won't be able to redeem. They'll have to, yeah, exactly. Like, I mean, if you really just want to get onto this thing, and yeah, I guess it is that.
Got it.
Cool. Now I just want to touch upon the governance model. The governance model is actually very interesting. Right. So so an advisory board is set up to facilitate decisions that that require interaction with the non-blockchain world and govern extreme scenarios. So it's got no custodial rights over the fund pool, can't release funds to any particular person, and each board member can be replaced at any time via the member voting process. So at the start, it'll contain several individuals or members of the mutual, so that advisory board that we spoke about earlier on. And right, so their key authorities are to facilitate and implement the wishes of the membership base, punish bad actors within claims assessment, meet legal and regulatory requirements. They've got this emergency pause functionality, which I'll get into in a second, and whitelist on and vote on proposals where required, right? So they had three concerns that they wanted to solve through their governance model. So member participation, so they wanted high participation, but they recognized that holding member attention plus gas costs involved in voting means that this is a challenge. They want to minimize any centralization because their DAO is a real company and they have a legal requirement to have a board. And they wanted to upgrade the code but avoid stagnation if member participation is low. So I really like the fact that they've actually outlined these three key guiding values from the very start with which they built their governance model, right? So now how the governance process actually works. So there's a board of 5 members that whitelist proposals. They provide a recommended outcome for each proposal. Votes are put to the entire member base for a token weighted vote. And it's capped at 5% maximum weight, which is amazing because honestly, that solves the whale problem that we've been talking about in governance. The majority outcome prevails if a quorum of 15% is reached. If the quorum isn't reached, the board recommendation proceeds, which is fair, I think, right? And that's the correct trade-off between centralization and decentralization that a DAO model should have, in my opinion. Now, tokens are locked for a period of time after participating in voting to ensure that those voting have a vested interest in the outcome of the votes. Again, great. There are token rewards for participating in the vote. And the best part, in my opinion, is that rewards are split between the number of members voting rather than the number of tokens voting. And because they have a KYC requirement to join Nexus, you know who the members are. And that's why this is the best form of governance, in my opinion, because you can actually have completely get rid of the whole one token, one vote model, which we've seen everyone implement, and everyone knows that this is not a good model because direct democracy has not worked. And to essentially have identified members voting is a really good sign because there's reputational risk firstly, and also the fact is that the outcome of the vote is a lot more fair, in my opinion, if members vote rather than the number of tokens that they hold. And another thing is that a member can delegate a proxy to vote on their behalf and still receive all the rewards in the vote. And a proxy can be any other member, and they can be revoked at any time, right? So I think that this governance model is actually one of the most developed ones that I've seen. I think it's a really good model. And I think that just in terms of avoiding some of the pitfalls of DAO governance, it does a really good job. One thing to obviously note is that it's possible because of the KYC requirement, right? So it's a double-edged sword because you do KYC and you get the benefits. You don't do KYC, you don't get the benefits, and you have to deal with like the kinds of DAO governance models that we're seeing, where we're really trying to understand how to implement a successful model without requiring each individual identity to be attested to. So I think that that's an important point to consider, right? Now they want to reduce board centralization by allowing any member to raise a proposal to replace a board member with themselves, which bypasses the whitelist gate. If accepted by the membership, they automatically join the board, and the board has no input on this process other than voting in their own capacity as a member. So I think that's a really good way to reduce centralization of the board. Now, something that I think is very cool is that their governance solution is built on the GovBlocks platform. I hadn't actually heard of this before, but this allows them for a lot of modularity in the governance process, so they can tweak a lot of parameters very quickly with governance. So voting weights, rewards, quorum levels, all components of the governance process can be changed very quickly and efficiently. And another thing which is awesome is that there's the ability to implement automatic actions. So it allows any changes agreed in the protocol in the proposals to be deployed automatically. So a proposal is agreed upon, and if, like, for example, you want to change a parameter in the code, or create a new smart contract for the entire code base, these proposal results are implemented automatically, so there's no lag, right? And that's the beauty of and friction free experience of blockchain and smart contracts and tokens that we wanted. So I think it's really good to see that they are implementing this. Right. So just a few trade-offs in terms of decentralization, but honestly, I'm not of the belief that you need to have extreme decentralization to achieve anything. I think that there should be a good balance. So for example, right, I think the off-chain capital model, the capital models run off-chain due to high gas costs, and results are notarized on-chain once per day. They want to move this on-chain in the future once heavy computation solutions become viable. The pricing model is also run off-chain due to gas requirements, and and it's posted on the blockchain once a day, which is good. And they're trying to mitigate the trade-offs of centralization, decentralization here. Now, there's a proposal whitelist process. So the advisory board initially whitelists all governance proposals, and assigns them a default voting outcome. And this voting outcome, the default voting outcome, proceeds if if quorum hasn't reached. Now the thing is that I think this is a really good thing, because I think that it's important for a protocol to be able to succeed and grow quickly without without being stopped in its tracks if there's not enough governance, if there's not enough voting participation. And they've got an emergency pause function which stops all transactions. Now this is actually a problem. I think that this needs to be, like, this is a proper centralization risk. And all advisory board members, they've agreed to using this only in extreme circumstances, but the type of field that we're in, I don't think that guarantee is enough. And yeah, this is like one of the bigger centralization risks that I've seen. But yeah, I think that overall, I think the governance model is really good. And I think that it's been constructed very carefully with a lot of thought. And yeah, and just if you guys have any thoughts on that.
Yeah, so I mean, overall, if you look at tokenomics and governance, they've clearly put in a lot of effort. It's just that unless a protocol is absolutely perfect in terms of its flywheel, even one, bad part in the entire cog can just derail the entire project. So with their whole redemption mechanism not being great, and this one governance centralization risk you spoke of, it could be a potential factor that leads to its downfall. But overall, I'm a fan of the idea,
Yeah,
at least.
exactly. I think that it's done very deliberately. Like, I think they've thought through this very carefully.
Yep, definitely.
Cool. The last thing I'll move on to, because conscious that we've been speaking for a while, is the performance aspect of this. So in terms of performance, right? So the active cover amount size today is, I think it is 143,860 ETH, while the capital pool size is about 153,732 ETH, right? So the capital pool needs to grow since it's getting closer to the active cover amount than it ideally should. Capital is 91.82% efficient, which is good, but it's veering into dangerous territory actually right now. Now, an interesting fact to note is that the losses experienced compared to total premiums paid are 34%, which is really high. So the claims accepted are $7.6 million, while the total premiums paid are $22.4 million. This is really high when you take into account premiums earned in 2022 are $5.7 million and claims paid out in 2022 are $5.4 million. Now that's huge, right? It shows the amount customers are paying for premiums, but also the amount of smart contract hacks and failures that have occurred this year. And this number's been significantly distorted by the fact that they paid 4.9, they paid $5 million because of the Rary Capital hack, which accounts for 65%, 66% of the total losses and 93% of 2022 losses. So it just shows you what can happen when they don't assess the risk properly, right? Like when they like, and not even properly, right? Like people thought Rary Capital was fine. Like people thought it had good contracts. They thought the team was great. It just shows you the danger of crypto at this moment in time. And that, such one-off events can have such a significant impact on, the amount that's paid out, and and just, just distort the losses so much. Now, the premium for this above cover ID, so it's 7149, right? So the $5 million paid because of Rary Capital. The cover started only on 4th April, and the payout date was 18th May this year. So it just means that the premium was not paid for very long, and the hack took place not long after the cover was taken. But assuming that the premium was paid daily, right? Like in terms of, if you say 10,766.55 and you divide that by the number of days between April 4th and May 18th, the yearly premium was only 1.77%, which is incredibly low. I think, at least in terms of but again, I can't judge this accurately enough because I'm not a risk assessor. But I think that the premium it seems like it was a bit low given the market conditions and given like the macro environment that had resulted after the Russia invasion of Ukraine. But again, obviously that doesn't translate into a smart contract getting failing or getting hacked. But in terms of just how nascent crypto is, a 1.77% yearly premium seems a little bit low to me. Now, it does show the robustness of the protocol, that it's paid out a large amount in one go, but it also shows the risk of DeFi in its current state, that contracts and pools that are deemed to be safe can still be so risky and still lead to such a large risk for the mutual, right? Now, the annualized premiums in force, they've decreased significantly since Jan 2022, and even more so from their peak in summer 2021. So this reflects and tracks almost exactly with the broader downturn in DeFi. And this makes sense, right? So with less funds in projects to insure, premiums and cover are bound to fall. And this is an interesting dynamic, since it's clear that Nexus Mutual success is highly positively correlated with the success of DeFi. And that makes sense again, because more projects to insure, more premiums to be paid, and more money to Nexus Mutual. So it's a very interesting dynamic that the success of Nexus Mutual is very closely linked to the success of DeFi in general. Now, the market cap of NXM in the market is $47.3 million, which is much less than the amount in the capital pool. But redemptions are halted right now, which means that there's no real value to holding the NXM tokens, other than staking them and acting as a claims or risk assessor in the hope that the capital pool rises high enough to enable redemptions. Now, since the pool is lower than the minimum capital requirement right now, and given the state of the market we're in, this will probably significantly lag market recovery and only be enabled after it's clear that the market has recovered. So this means that the value of the NXM token is only to purchase cover at the moment. And given how cover has been trending with NXM, demand for the token is probably not high. So this is a bit of a paralysis state that they've reached, right? And what that means is that they need to reduce token price significantly, and in order to encourage people to actually buy cover for their protocol. And they're just going to have to take the loss, and in order to gain more activity on their platform at the current moment. Then the capital efficiency ratio, since August 2022, since last month basically, it's ranged between 77 to 100%. And as of September 18th, so 5 days ago, it was 77%. Since the capital pool size is already below the minimum capital requirement, Nexus needs to incentivize the injection of liquidity into the capital pool by lowering the price even more. This disadvantages current NXM holders, but it may be the only way to shake the paralysis, attract capital, and grow in the bear market, like I said, right? And their 12-month rolling revenue statement shows heavy losses at $56 million, of which $52 million were attributed to investment losses. And this is in line with the broader market, but it also shows a need for a more prudent risk management, right? So they might need to deposit into uncorrelated assets like Goldfinch or things like that in order to be able to not be exposed to the wider fortunes of the crypto market. Right, and also the fact that the investment strategy may not be as lucrative as initially thought. But yeah, I think that that's essentially the way that Nexus's performance has been trending. But yeah, I think that that's it from me in terms of analyzing Nexus and how it's done, um, and how it works. I think overall, I think it's a really good protocol with a really good idea, and I think it makes a lot of sense. And yeah, in general, I'm pretty. I think that this structure can be replicated pretty well, and if they sort out the redemptions, and if they sort out like this stasis that they're in right now with terms of token price and cover purchases, and if they can expand to products that are not correlated with the wider DeFi market, and with DeFi in general, then they have a higher chance of succeeding. But yeah, overall, I think that I'm pretty positive on Nexus.
Right.
Yeah, I think it's a commendable job for the space they're approaching, which is highly complex. Of course, we've
Yeah.
not touched upon the regulatory aspect, but I mean that's true for any project.
Yeah.
So I mean that's just part and parcel of building in the space. But other than that, I think, and how old are they? How old? When did they start?
I think they launched in 2020, but I can't be sure. I haven't
Didn't they do an audit in 2019?
Oh, sorry, yeah, the April 2019. Yeah, so they must, I think
Yeah.
they launched in 20 they must have launched in 2018 or 19.
Yeah, not bad. I think for 2 3 years in such a segment, I think they made
Yeah.
really good progress.
Yeah.
Agreed.
Yeah,
Cool.
I think we can wrap things up now.
Perfect.
Yep.
Cheers. I think, yeah. Yash, go on.
Yeah, that's all from us. I just wanted to say thank you to the viewers for listening in again, and I hope you guys enjoy this episode.
Cheers. Thanks, everyone. And see you next time.